Hello, everyone. We are about to start our webinar. Thank you, everyone, for joining us. My name is Talha. I'm partner with BSA. BSA is present in UAE for audit, accounting, and management consulting services since 2006. This is second episode of our webinar series, Taxperience. Today, we will be covering the topic of classification of persons under UAE corporate law. Now, I would like to introduce our esteemed speaker, Sabah. Sabah brings more than 10 years of experience in corporate law. She's going to explain a bit more about herself as well. And Sabah, we are looking forward to the insights on today's topic, and thank you so much for your valuable time. Furthermore, we have our very own Mohsena, partner BSA. She will be moderator for question and answer session. For all the participants, please drop your questions in the link shared in the meeting chat. In case we are not able to answer, we will make sure we get back to you over the email as well. Let's get started, Taba. Stage is yours now.
Hello, everyone. Good afternoon. So, this is our second session on the series we are having. And today we're going to talk about the second tick, different types of person for UAE corporate tax. Some of the people who attended the first session gave me a feedback that for the time I spoke was not enough, but I think the first session was more about a background introduction and it took around 15 minutes of the overall time. So I'm still sticking to 45 minutes for this session, and I am happy to take a feedback if you guys want us to extend the time even further, then we can see and extend it. Again, this is the same presentation which we have discussed before. This is a brief detail of all the documents we have until today, and it's updated as of the new guide which has come 2 days ago. I'm gonna again, as I said last time, I'm gonna tick mark everything which we're gonna discuss in every slide, every series or every session, and I'm highlighting going forward whatever we're gonna discuss in that current session. So this is all you can have it later on from me. So coming to today's session, we're gonna talk about different types of person, mainly exempt person. I know it's gonna take up a lot of time, and then we can move to out of scope person or taxable person as the time allows. If not, we will carry it forward to our next session next week. So the start of this discussion is on the same slide on your right. So the persons for UAE corporate tax are three types. It could be a taxable person, exempt person, or out of scope. I'm going to start my discussion with exempt person, and then we will talk about taxable person, and whatever which could not fit into taxable or exempt can be an out of scope person. Now, coming to exempt person, where we're going to start from, it can either be an automatically exempt person or exempt through an application. So this is we are going, in our sessions from last one to this one, as of we have two, we're gonna be taking through as the law flips. So we are on the Article 4 right now, and we're going to go each article wise ahead, and we're going to take up through any ministerial decisions or anything else which is coming across, and that's how we're going to finish the whole law. So Article 4, it talks about the different types of exempt person, and it starts from automatically exempt. So there are four types of persons which are automatically exempt by law, and then there are five types of person which are exempt by application. So it means not every of them can be exempt, but the first four will definitely be exempt. So it starts from government entity, government control entity, then extractive business and non-extractive business. We will go in a little bit of detail about each and every one. The exempt by application person, the key takeaway here is that you can either be exempt for a whole tax period, or you might not be exempt at all. So if you are a qualifying benefit entity and you fall under all the you qualify all the conditions, you are in the cabinet decision, and that's how you fit into that. Your FTA gives you a go ahead that you are an exempt person, but even after that, you can only be exempt for a whole tax period. You cannot be exempt for half tax period and half not. So if you meet the conditions, let's say you start meeting conditions from mid 2024, then in 2024 you will still be taxable, and you will only be exempt from next tax period. And we're gonna go into the details further now. So starting from the first entity here, the government entity. So the law says that a government entity shall be exempt, and that's very obvious, yeah. a government entity needs to be exempt, why the government will pay tax to itself. So the only condition is that it should not be earning any business or business activity which is not under the government licenses. So government entities also have their own licenses, yeah. So they need to abide by those licenses, and if they do any other business other than that, then they might be taxable for that other business. The only exception is that if that is a very ancillary activity or which is very incidental to actually the government business, then it might not be required to be taxable. And if they have business and income and the government entity's license income, which is actually not an income, it could be just a cash flow, then the way they're gonna transact with each other, the business and the government entities part, they will be considered related party for each other. So they will have to keep the documentation, they'll have to keep their books separately. This normally doesn't happen, that if there is a government entity, they make sure that they are not doing any other business activity. The definition is almost the same for the government controlled entity as well, but in the government controlled entity there is no license, there is a mandate. So the law says that the government controlled entity can be an exempt entity, but it needs to stick to the business or business activity which is mandated to that company or to that entity or organization. If it's deviating from the mandated activity given by the government to that organization, then it might be subject to UAE corporate tax law for that business or business activity which it's not mandated for. And then it will again have to create separate books for both the activities, the mandated one and the non-mandated one. And when they will transact with each other, they will be considered both as independent parties, and they will have to make sure that they are on arm's length, and they will be considered as related party transactions. But otherwise, for the mandated activity, they will be automatically exempt in government entity case or a government controlled entity case. In the case of extractive business, I guess we all know, we live in the GCC, that there is oil extraction, there is gas extraction. So these company anyway pay tax to the government through different legislations which they have with the Emirates for each and every company separately. So these companies have specifically been exempted by the law that for the extractive business, you don't have to pay further tax, UAE corporate tax, but because they're already paying tax to the government. But if those businesses are doing any other activity which is not extractive business, then they need to be subject to UAE corporate tax law. So, for example, if a company is into oil extraction and now the extractive business is the oil extraction, okay, now that company also do distribution and that company also do retail. Mostly the same company never does it. There are different companies for distribution, there's a different company for retail. There could be another company which is like head office management services company. So the other parts of this, extractive business which are surrounding the extractive business, like distribution, retail, head office support services, those businesses will be subject to UAE corporate tax law, and those should have separate books, and the extractive business should have separate books because they have to pay different types of taxes. And if they have common expenditure, then the law has specifically mentioned that the expenditure needs to be apportioned. Regarding the transaction between extractive and non-extractive business, again, they will have to be considered as independent businesses and they will be considered as related party transactions. So they will have to make sure that they are on arm's length. Then there is another term which is called non-extractive but natural resource business. So again, they also pay different tax to government. So that has been specifically exempted by the law. And they again don't have to apply for taking an exemption. It's automatically exempt. And such businesses, they have specific license for the natural resource business. So again, for that specific activity only, they are exempt. But if they do another activity, again, distribution of that natural resource, a retail of that natural resource, or a head office company, again, as an example, which is maintaining whole business or the group of business, then the other businesses which are not specifically licensed as non-extractive natural resource business will be subject to corporate tax as usual, like any other company. And if they transact with each other, they will be as related party transactions. They will have to maintain separate books. And if there is a common expenditure, then they have to apportion it according to some basis. So these four articles, Article 5, 6, 7, and 8, it talks about the automatically exempt companies. And now from Article 9, we talk about the first company which is exempt, but it is exempt subject to conditions. So any qualifying public benefit entity, so the examples are like entities in the healthcare, environmental research, religious entities, which I would not say companies, but these are entities, religious entities, charitable entities. There are so many other entities which are created. They are the law doesn't say they cannot be profitable or they need to be non-profitable, but they should have a license according to the purpose of that entity. Or the second B part is that it could be a professional entity, but like a chambers of commerce or any other exclusively created entity for the promotion of social welfare or public benefit, like Ministry of Finance or Department of Finance, any other entity, RTA. So qualifying public benefit entities again need to go through certain scenarios to come and fulfill the exemption. Now, they the law here is not flexible in the fact that they can do any other business. So it cannot do any other business or business activity other than the purpose. The purpose is the benefit of the public or social welfare. Now, the example could be different than that, but if there is a business which is for social welfare or public benefit, then they can start, their hunt about can they be exempt or not. Now, there is a cabinet decision about it. It's decision number 37. And this talks about a list of entities which are qualifying public benefit entities, and they have been recognized by FTA already, sorry, Ministry of Finance already, uh, as qualifying public benefit entity. So qualifying public benefit entity will only go and register for corporate tax as per the guide, and then it will see if it falls under the cabinet decision 37 or not to be qualified as a qualifying public benefit entity, but it does needs to keep maintaining the conditions as defined by the law and then explained further in the corporate tax law. The I have put some important points about the guide, which are, the guide is very big otherwise, but these are some of the takeaways of the guide, which is specifically related to qualifying public benefit entity. And the guide says that, it, it should be a company which is listed in the decision, and it can be only for the purpose of public benefit, and it cannot do any other business than the purpose of having a public benefit entity. And then the guide also mentions one more thing, that if you are a taxable person and you are making a donation, grant, or providing a gift, you are actually paying in a common as a common word to any of these entities. Yeah. So you as a company, is a normal company, you pay corporate tax on 9%, but then you make a donation or you pay or support any of the religious charitable entities. Okay. So when you do that, you can take a deduction if those entities are listed in, again, the same cabinet decision number 37 of 23. So it's a big decision. It comprises of a lot of pages, and there is a list of literally entities, and you can skim through it and you can find the entity for which you have donated, and if it's there, you can take a deduction for calculation of your taxable income. Now, the other type of company is a qualifying investment fund. Now, investment funds are very interesting. Yeah. So there are two types of investment funds which I can categorize them into. There's a public benefit investment fund, or I would say public funds, and then there are private funds. But here the law either talks about any of the funds or the law talks about pension funds. So let's first talk about what the law says. So Article 10 of the law talks about what qualities the fund needs to have to become an exempt person. So, I mean, if I go back and apart from tax, if I talk about what is the function of any fund, an investment fund. So, many investment companies create investment funds to, and they you get units of those investment funds. You can purchase them as public or as a private. It might not be a public investment fund, it could be a private investment fund. So as public or private funds, you can purchase the units, and then you can earn a certain type of income on that, and then when the fund closes, the all the income of that fund gets distributed. So in other mature jurisdictions, most of the time the investment funds are not taxed, because they're kind of passed through. And why they're passed through? Because it's your and my or even corporate money, but it eventually comes in the pocket of that corporate or that person. So it should be taxed on the that corporate level, or it should be taxed on that person's income level instead of getting taxed on the fund level. But the corporate tax law slightly deviates from the other mature jurisdictions, and there are certain conditions. If you don't fit into that conditions, and if you are an investment fund, then you might still be paying tax on the investment fund. So let's say if I am investing as a person into an investment fund, I am buying, let's say, 50 units of an investment fund, and I'm investing, let's say, 20,000 dirhams. Okay. So the sad part is that if the fund doesn't meet the conditions, I might be paying tax on my income overall to an extent, considering the effective tax rate, whatever the fund will calculate for its taxable income. So coming back to the conditions, the investment fund need to have like a fund manager, and it should have a regulatory oversight, and then it should be a fund which is easily and widely available to investors, which gives you a hint that they are only talking about public funds which are mostly listed in stock exchanges or other types of exchanges. And the main purpose is not to avoid corporate tax. So as I explained, yeah, so funds in many jurisdictions are not taxed because of the nature of the fund, so they are passed through. And then because there is no income tax on our personal incomes, so if that fund would have been passed through, we would not have had to pay tax. But I guess to cover that element, because in other mature jurisdictions you do pay personal tax and here you don't pay personal tax, so that's one of the reasons that the conditions here are slightly different. So if it's a private fund, that then it doesn't actually fit into these conditions of getting an exemption. Now, this article also comes up with a guide. I have given the guide numbers everywhere and the names of the guide, so you can easily refer later. And then it also comes with a ministerial decision. So I'll first talk about the guide here to the public, and the guide is only about the pension funds and social security funds. So pension is required for certain employees, and social security fund is now also being established. So the law says that such kind of pension funds and social security fund, public, if they are public fund, they might fit into the first condition anyway. But if they are private, then they can also get an exemption. And in that case, they will not have to pay tax. The idea behind is that because it's a pension fund or it's a social security fund, it doesn't make sense that we should be taxing it. And it's a very very good thought, and I really feel that they have thought a lot before taxing anything. So imagine if you are earning pension, and you are being taxed even on your contribution on the pension and the investment or the income you generate on the pension contribution. So that's a good thing about FTA, that they think about this, and they are not taxing at least the pension and social security fund. So there are still conditions to that, but the ministerial decision says that it's subject to approval of the FTA, but the fund needs to be only about assets which are pension plan assets, and any of the asset which has been acquired, financed, or through the contribution of the employees or employer, they should be exclusively for the pension plan benefits. And then the members of the pension plan should have the rights to claim and entitle the assets and the earning. So that's the the idea behind it. It's not a fake fund, it's a realistic fund, and the owners or the members of the pension plans have all the rights to its assets, and they can claim the contribution from it. And it's they have defined that the fund can only be comprises of a certain kinds of income. So the article 4 of this decision literally specifically talks about only the types of income which the fund can earn. So the gray box on your left talks about the type of income. Now it's the 4 types of incomes. Like you can have underwriting commissions, you can have rebates for managing the funds, you can have investments or deposits on that fund. So the fund's purpose, it triggers you that if you will see the types of income, that the purpose behind this fund is to maintain a pension money for the members. It's not to actively go and invest in different kinds of investments and do anything else, and literally create another type of business. So the idea is to have a pension fund and to maintain that pension fund, and the fund must also have an auditor. So in that case, if even it's a private pension fund, so many private pension funds are available, maybe not in the UAE, but just as example in many other mature jurisdictions. So, and you can literally go and pay yourself and be having some deposits for your retirement. So that's the plan, and that's the idea here. So if you're investing in a private, or even private could be like every employer might have their own private pension fund, for example, yeah. Or if you're investing in a public pension fund, then, or so most of the cases, it will not be subject to corporate tax. So there is another element in the guide which is very important. Again, the guide is very big and I have taken only the key takeaways here. The another important point here is that when the employer is gonna do a contribution, so let's say your company is normally subject to corporate tax at 9%, and now your company makes contribution to another pension fund, okay, which could be exempt. Now the contribution which the company makes, the deduction of the contribution allowed as per the law is 15% of the value of the remuneration of the member. So let's say, to simplify it, um, if I am the member for who the company is paying as pension contribution, so the company can only deduct 15% of my value of remuneration from taxable income while calculating its taxable income. Let's say my company is very generous and it pays 20% contribution into the pension fund, 20% of my remuneration value. Yeah. So in that case, they will only be able to deduct 15% when they will calculate their taxable income, and 5% will be disallowed. So that's, I mean, for any normal company who is even having a contribution to a pension fund, this is an impact and this is important, and it's coming through the guide. Another ministerial decision which talks about exempt person, not specifically any types of exempt person, but it's linked to an exempt person. So I have thought of covering it here and talk about it. I think my point of view is that there are still more details are should be coming about this decision, maybe a guide or maybe further clarification, but we only have it to an extent. And also somebody asked me this question, and I you require an NOC before you can close or liquidate a company, yeah. And it's a very vicious circle. So we haven't seen the term NOC in any of the documents which have been issued by the government yet in the UAE, but we do see this, and we do see a reference that you need to give a notice within 20 business days from the date of beginning of your procedure. Now the term, the date when it starts liquidation procedure, is very vague. I mean, for my legal or my for my management, we might start liquidation the day we decide to liquidate, yeah. But for FTA, what is actually the date when they think yes, this company is starting its liquidation as per FTA? That still needs clarity. The other aspect here is that you still need to register for corporate tax even if you are under liquidation before 1st Jan 2024. So let's say I have a company and it's under liquidation since June 2023. So I still have to register it for corporate tax, and I have to intimate within 20 business days from the date of its beginning procedure, means from the, as soon as I can. So I don't have a clarity here because it's not been clarified yet. Now there is an FTA decision number 7 of 2023, which talks about specifically exempt companies and their corporate tax registration. And it's very different than the tax registration decision which came recently a week ago. So it says that, we saw a list, yeah, for 9 entities. 4 were automatically exempted and 5 were exempted through application or approval. So these are the 5 entities which are the second one. They are subject to approvals. So the first one, qualifying public benefit entity, it needs it had to register as of 1st October 2023. Yeah, so that time, I mean, these companies would have most probably registered themselves, and if not, then they should register as soon as possible. So at least, they are not further delaying the process. And once they will register, they will know their name is already in the decision number 37. Yeah, so they will be subject to exemption according to that. Now, the rest of the four, which have to specifically do an application, they have a time until 1st June 2024. Now, this decision came much before the new tax registration deadline. So, I, as a tax advisor, would not suggest you to wait for 1st June 2024. I would suggest you to go by your deadline, but I do advise that register by May 2024. So, I would advise the same, that even if you fall under these four, although this decision says otherwise, but you should register by May 2024, and then you can wait for the application, to be available, and then you can apply accordingly. So after your registration, the law says that you have to apply within 60 business days from the end of the tax period in which the person meets the condition. So, in the start, I said that if you are exempt and you're meeting the conditions for exemption throughout the 12 months of your tax period, only then you're going to get an exemption status, because you can only be exempt for a whole tax period. You cannot be exempt for half of the tax period. So the so the law says, let's say your tax period ends on uh, December 2024. Yeah, that's how it is for most of us. So when in December 2024 your taxable period ends, you analyze yourself, and within 60 business days you have time of 2 months to apply for exemption. So you will be very clear, and you will be able to assess yourself for the whole 12 months. Was I meeting the conditions of exemptions throughout 12 months or not? If you were, then you apply. If you were not, then you will not get a prorated exemption. You apply next year when you are fully exempt. So that's for the last four, that you have time for 60 business days from the end of the tax period, or you can say financial year. For the first one, you're already in the cabinet decision number 37, so you don't have to worry about that. But you do have to meet the conditions of qualifying public benefit entity itself. Then there is another FTA decision about exempt person, and it's not big, but it's important, because for the last five exempt persons who are subject to approvals and applications, you might not be meeting the conditions, right? As I said before. So every year, FTA requires a declaration, and what you're gonna declare, we don't know that yet. But 9 months from the end of a relevant tax period. So for the first year, you will first of all apply within 60 days of the end of your tax period. Okay. And then maybe from the first year, or maybe from the next year, you will have to file an annual declaration, and it will be something like that. I declare that I'm still meeting the exemption conditions, and in that case, I mean, you will continue going ahead. And this is just to make sure that you are vigilant and you are responsible, not FTA. So you are responsible to self-assess yourself, and you are responsible to make sure that you are meeting the conditions for the whole 12 months, and that's what you have to declare. And this is in reference to the tax return. So, we have 9 months to file the tax return after the end of the tax period, and you have 9 months from the end of the tax period to declare. So at the time when you're filing your tax return, you will be filing a paper which will be like an annual declaration for exempt person, something like that. And you will just confirm that you are still meeting the conditions. So might not be for the first year, but I think it will be for the first year, and even going forward all the years. Then we come to the taxable person definition. The law simply defines a taxable person, that a taxable person can either be resident or non-resident. So just let me just take you. We are standing on Article 11, and when we are talking here about the last article, it was Article 10, talking about qualifying investment fund. So we are still, in the same series. I'm not skipping articles. I'm taking you one by one how the law is written. So this is the definition of taxable person. We have seen this definition in our previous session also, but over there we saw it from the angle of tax base. Today we're gonna see it from the angle of taxable person. So I'll be very quick on this because we have discussed it before, and then we can open for questions. So the law says you can either be a resident person or a non-resident person, you can still be taxable. Now, remember that the free zone comes later on. First, you decide, are you a taxable person or not? And then if you are a taxable person, then there is a next step to see, are you a mainland entity or a free zone entity, okay? So you could be a legal entity in UAE, including prison, then you become a taxable person. You could be registered in BVI, but your place of effective management could be in UAE because the BVI company could be a shelf company. And again, you will be considered as normal as any other juridical person and you will become taxable. You could be a natural person who would be conducting activity in the state, means in the UAE. You could be a partner of an unincorporated partnership, which is in the UAE again. And then you could be a non-resident having a permanent establishment. You could be somebody as a non-resident company person. You could be anybody, yeah. And then you could have a state-sourced income. And then you could be somebody who have a nexus in the UAE. Again, it could be a person, it could be a company, it could be a natural person. And then the law, this article also says that if you are a branch in a state of a resident person, so most of us have more than one license, yeah. So we have maybe a main license in Abu Dhabi and branch of a license in Dubai or vice versa, or you could have, license in each and every emirate. So if you are a resident person in the UAE and you have branches, then all of them will be considered as one taxable person. You will not have to maintain different books, except if any of them is are going to be qualified for free zone benefits. So we're gonna see it later on, but a branch can also qualify for a free zone benefit and maybe not the other licenses. So in that case, you might have to maintain different accounts. So I'll double, discuss a little bit that if you are a resident person and you are taxable person as well, so then your worldwide income will be taxable in the UAE. But if you are a non-resident person and you are only here through a link like a permanent establishment, or you are driving a state source income, or you have a nexus, then for a non-resident person it will be only subject to tax for the part of the income which they are earning from the UAE, through the UAE, in the UAE, whatever you say, but only for a certain part of income. So example, if I don't live in the UAE, I live in Saudi and I just have a permanent establishment in the UAE, so only the income of my permanent establishment will be taxed in the UAE, not the whole income of Saudi plus the permanent establishment, because the Saudi part will still be taxed in Saudi. So just to avoid double tax, a non-resident will only be taxed for a UAE attributable income, and a resident will be taxed for its worldwide. And then there are benefits of tax credits and everything, double tax treaties, which we will be discussing later on. So I'll now open up for questions and I'll hand over to Mohsina.
Thank you, Saba, for the nice presentation. Here we get some question. Audience, if you have any question, you can send in the mentioned link in the chat box. So we got a question from Huzaifa. In qualifying free zone activity, there is one activity which is distribution of goods or materials in or form a designated zone to a customer that resell such goods or material or parts thereof, or process or alter such goods or materials or parts thereof for the purpose of sale or resale. Can you please further elaborate it how we can interpret it for trading business operating inside the designated free zone and they are doing mainly high sea sales of goods? Is it mandatory to import the goods and then re-export it to qualify for it? How will it work?
So Mohsina, who sent the question? Sorry, it was very
Huzaifa.
long.
Huzaifa.
Yeah, I don't have the visibility of where to see the question, although Suhaib has given me the link, which I've missed somewhere. But sorry, who has asked the question? Is that
Huzaifa.
person here? If they can speak up.
Hi Sabah, it's me, Huzafa
Hi.
here.
Hi. So Huzefa, I'll take up from what I took from Mosina. You want to know about the distribution business, yeah, in the free zone, as a qualifying business income, and you want to know that does it needs to be imported through a designated free zone?
Yes, actually, in the law, it's mentioned. I Let me just open the question again.
Yeah.
Actually, in law, it is mentioned the goods distribution of materials in or from designated zone. So my question where I'm confusing it, either, for example, the client is doing a high sea sales, or his goods are not coming into the UAE from China or from anywhere in the world. He is buying it from somewhere and selling it to somewhere. So will it be qualify as a qualifying income, or the goods must be import into the UAE in a designated zone and then re-export from UAE, from the UAE port to any part of the world? So this is my question.
So, Josefa, I'll not be giving you the answer today. There is a free zone guide which needs to come maybe tomorrow if you are lucky, just before Ramadan. And if you will hold out, I'll give you an
Mhm.
answer once we have the guide. So for now, there is a big confusion about the distribution business, and
Mhm.
there is not big clarity on how you import and then export. Do you need to import specifically from the designated free zone, or how it works and who actually comes under even the distribution business itself? So if you wait for one more week, I'm gonna give you a right answer once we have the guide.
Thank you so much, because it's a very
I
confusing
know.
point for us, everyone. Because I've been checking a lot and reading a lot on the free zone, and I'm not able to find the proper answer, a satisfactory answer, especially on this point.
Everybody is confused on the distribution income, and I hope we're gonna, even the big four, they are waiting on the guide for now. So I'll advise you hold for one more week and we will have the guide,
Okay, thank you so much, Sabah.
and then we can see. I mean, we are expecting it to become very clear once we have the guide, but we
Okay,
not sure it's gonna come this week or not.
okay, thank you so much. I'll wait for one more week.
Let's see. Yeah, you
Thank
can
you.
drop me a LinkedIn a message and then we can chat about it once we have the guide.
Okay, I think I dropped to Talha, but I will drop to you a message also. Thank you.
Sure. Mosina, do we have more questions?
Uh, we have one more question for Imran. Can I get the slide, please, for each
Yeah, yeah,
session?
yeah. That's
Imran,
fine.
we will email all slides to all the participants. Till no more question from the audience. So I think we can wrap up as we are already at the end of our time.
Yes. So anybody else, if they want to speak up, we have 3 minutes left. Otherwise, we will end the session today. That's all. Thank you all for joining and have a good evening.